Good afternoon and welcome back to those who joined us in our first session last week. Welcome also to those joining for the first time in this year's banking conference, which we are holding virtually for the first time. In the first session, we had a great discussion about the roles of banks, central banks and governments in the COVID economy, the importance of addressing problems early and swiftly. Today's session on payments, competition and tech players in finance will take us to the new, quickly evolving digital landscape in payments and financial services and the importance of fair outcomes for society. Today's panel, moderated by James Harding, brings together vast expertise and very different perspectives on some of the issues we face. I would like to thank the panelists for being with us today. We think you are the best place to tackle the subjects of today's session, and your contributions will be most valued by the audience, we are sure. We are also delighted that 2,900 people have registered for the conference as of today. Please use our conference app and web page, which has interactive features that we hope are useful for you. On the right side of the screen, you will see a window in which you can send questions to the panelists. And below that, you'll also see a panel called Voting. And James will send a few questions to you, so please participate in these surveys. Again, thank you very much for attending, and thank you, James. Please, James, thanks.
Alejandra, thank you, and good morning, good afternoon, good evening, wherever you are in the world. Thank you for joining us. As Alejandra said, we're incredibly fortunate today to have an exceptional group of people discussing what is, by any measure, one of the defining themes of 2020, the revolution that technology is causing in the world of financial services. To give you a tiny smattering of facts, we know that we are more reliant on digital than ever before. What's striking is people who've never been reliant on digital technologies embracing tech as a way of transacting. And whether it's been the fact that 35 million people in Latin America in the March quarter used technology to transact in a way that they'd never done before, that contactless financial transactions was up 40%, that 35% increase in the use of digital financial services in the March quarter. The pandemic has clearly accelerated a revolution that's already begun. And so we are particularly fortunate today that we have Dan Schulman, the president and chief executive of PayPal. Many of you will certainly know of Dan and no doubt know PayPal. You've been thinking about these issues for far longer than we have, and we're extremely grateful to you, Dan, to be here. Frank Souza, who is known to many people for building or helping certainly to build one of the most successful digital businesses in the world in Cognizant, and is now the senior advisor to Banco Santander and centrally involved in thinking about what an existing established bank looks like in the digital age. And we're delighted too that Nuria Oliver joins us as well. Nuria is the co-founder and vice president of the European Laboratory for Learning and Intelligent Systems, ELIS. I say that with a smile because when you look at Nuria's CV, and you should do, you'll discover that's one of about 7 things that she does. So I'm giving you only one of your titles, Nuria, but that's going to have to do for now. We're going to try to, in the course of this hour, look at payments as a gateway into understanding the transformation of financial services through tech. We're going to try and think about the platforms that emerge and the impact on the financial system. And we're going to talk too about people, what happens as a result of this, the impacts on people. And I hope that we really will have a conversation between Dan and Nuria and Frank. But we want to make sure that your thinking has an input on this too. And so, as Alejandra said at the start, we would really love you to vote. We'd like to do a little bit of polling. Between each question I ask, I just need you to refresh your screen so you can vote on the next issue. It's like a proper ballot in this sense. There's not just one question on it, but a number. And I'm going to start, if I might, just by asking the question that I ended with there, the people question. The question you'll see that will come up is whether a cashless economy will be more or less inclusive. So I hope that this question is going to crop up on your screen and you can vote on it now. Will a cashless economy be more or less inclusive? And whether that's landing, Dan, can you give me a thumbs up if that's landing on your screen? And maybe it's not on mine because I'm speaking. Thumbs down.
I don't see it.
The beauty of it, Dan, is that there's something very simple about old-fashioned voting. Funny enough, you know what? We had this. The brilliance of this, by the way, is that we had one of these sessions when we were doing a Santander International Banking Conference, and actually, someone when we were in the room all together at the time said, "Should we just vote with our hands?" You know,
Much faster.
The place. So listen, I'm sorry that can't come up. Yeah, okay. Forgive me. I'm sorry for the interruption, but let's get started then. Dan, can we start with you, if we might? What is happening in the world of payments? What does the pandemic do to, as I said, a revolution that's already begun? And how does that change the financial system?
Yeah. Well, I think we're going to see more change in the next 5 years in the financial system than we've seen over the past maybe 50 years. And maybe I'll take a little bit of a step backwards to answer that. You know, the current financial system has been in place for some 500 years. You know, the goals of the financial system and central banks have always been to provide, you know, trade-offs between growth and stability, monetary autonomy. And today, if you look at the global financial system, it is quite complex and it's also quite expensive. To give you a sense of the size of it, it intermediates about $300 trillion of funds flow. And it generates revenues off of that of about $5.5 trillion. Those are the annual revenues in the financial system. And so the take rate is about 1.9%, James. And that's been persistently high for quite some time. In fact, over the last decade, that take rate has only come down by about 20 basis points. You know, and think about that. You've got scale and technology, and that take rate is still very high. But the real disappointing thing about that take rate is that it's actually quite skewed. Those who are, let's call it less well served by the financial system,
right,
you know, they can have take rates of 10% or higher. In the US alone, last year, those who are underserved by the financial system spent somewhere around $160 billion on what I would consider to be unnecessarily high interest rates and fees. And so this whole massive acceleration of digital that's really coming out, it's been in place for quite some time, but the pandemic has accelerated that by maybe 3 to 5 years, is changing business models of every industry, and no doubt will put a lot of pressure and a lot of emphasis by regulators, by central banks, and by those of us inside the financial system to accelerate and probably dramatically rethink our business models.
And underlying your point about the take rate, Dan, I presume is an argument that says a system of digital payments will inevitably lead to a lower take rate and less of a cost to the consumer. Or is that
well, I believe that's true. I think there are that the real moonshot of the financial services system, I think, is how can we help to drive not just financial inclusion, which is mostly defined by how many people have a bank account. I think we've made good improvements on that throughout the world. But really, can we help to drive financial health?
Mm-hmm.
Financial health being, do people not just have the ability to be able to have an account, but can they actually generate savings? Can they manage and move their money efficiently, safely, securely? Can they create budgets? And I believe that the explosion of technology, predominantly mobile phones, which almost everybody has, and the cost of a smartphone is dropping quite dramatically. In India, the cost of a smartphone is like $25 right now, and that will continue to come down. You've got more and more high-speed networks that are coming, and then you have platforms like a PayPal, like some others that can connect automatically to built-in distribution. You really have all the power of a bank branch in the palm of your hands right now through a smartphone. And I'd argue that technology can be part of the solution of lowering that take rate. It should be able to reduce the cost of basic financial transactions quite substantially.
And is the starting point of your argument right, Dan? Forgive me, but the financial system.
I forgive you, Jim. I forgive you.
As we look, forgive me broadly, but particularly for this, the experience we all had in the decade since 2008-9 surely taught us a lesson about mismanagement of the financial system, risk in the financial system. And there would be some people who might say to you, yeah, Dan, fair enough, 1.9% is the take rate. But if you want to create systems that have security, that think about proper prudential management, that mean that we can have oversight of what's at play in our economy, we're going to need a well-resourced financial system. And so operating at very, very thin margins might be short-term good for the consumer, but long-term bad for society.
Yeah, I mean, I disagree with that proposition. I don't disagree with the fact that enterprise risk management, compliance, all the fraud management, FinCEN rules are foundational to any financial system, foundational. And the partnership between central banks, between financial institutions, regulators, fintech, is essential. Because really, what is money, but really a representation of value, and really is based on trust. Right. That is the number one thing that probably all of our brands rely on. And so, but I don't think that, I've, since I've been at PayPal, have invested multiple hundreds of millions of dollars into risk and compliance and security, and will continue to do so. But I don't believe that that's an excuse to have a take rate that is so high that it basically excludes people from the financial system. I think, as we digitize, and the world is moving towards digital, and rapidly, and central banks across the world are recognizing that, banks are recognizing that, technology players, retailers, it doesn't matter what industry you're in, everybody is recognizing that. The costs to serve is dropping. And so we need to think about ways of assuring that people are included in the digital economy going forward. This is to your initial question. We have to assure that there isn't a divide between those who have access to the digital economy and those who don't. I'm in the camp, and I'm curious to see what the voting results will be. I'm in the camp actually that technology should actually provide a dramatic increase in inclusion. But how you think about that inclusion may be different than traditional ways.
Okay. Dan, I'm going to come back to you because on the point of financial health and the financial system, I think as we look at platforms, I want to talk about that in more detail. But Nuria, I just wanted to take your initial thoughts on payments and how a revolution in payments you think impacts the financial services industry more generally and the consumer.
Thank you. Thank you for being here. It's a pleasure. So, I mean, I have to say that maybe picking up on what Dan has mentioned, it is actually not a coincidence that in the 2000s, even before it was adopted in developed economies, peer-to-peer mobile payment systems like M-Pesa were developed in developing economies as a way to foster financial inclusion to the unbanked, because there were indeed many more people having a feature phone, not a smartphone, that they could actually use, that they could send SMSs with. There were more people having that kind of phone than having a bank account. So being able to send money to others or pay bills via SMS became a great technology solution for financial inclusion. Yes. For a lot of these people. So I think in the mobile payment, mobile and money spectrum is actually the early adopters in many ways have been developing economies, not developed economies. And in developing economies are kind of like maybe skipping the credit card intermediate step that we have had in developed economies. In terms of the electronic payments and the role of the pandemic and the global scenario, I agree with Dan that the COVID-19 pandemic is acting as an accelerator for moving towards a more maybe cashless economy. Fundamentally because during the confinement, we actually were not able to purchase almost anything if we didn't have an electronic way to do it, because we were confined and we couldn't leave our homes. But even after confinement, there has been an explicit recommendation in many countries by governments to avoid using banknotes and coins and use credit cards or other electronic payment methods to minimize human interaction and to minimize the potential exchange of objects, that might be infected, even if there isn't maybe a huge amount of evidence on this. But so there has been a little bit of a push towards using electronic forms of payment. And we have seen in the numbers that there has been a huge surge in the use of digital and contactless payments and a decline on other types of payments. So this we know. And something else that we also know during the pandemic is that in many economies, there has been a significant drop in consumer spending. And there have been sectors like the travel, hospitality, leisure, entertainment sectors that have seen drops of up to 70% in consumption, because a lot of these activities, you can't, do them anymore. And we also see an increase in saving cash. We've talked about trust. And I think people have deep-rooted trust in paper money and coins, particularly in uncertain times. So I think the pandemic has also encouraged people to save cash as a sort of like store of value, right? So we have a little bit this sort of like tension between these two phenomena. But I think it's inevitable to think that we are going to be moving more and more towards cashless sort of like economy. There are certainly a lot of advantages of doing this, but there are also disadvantages that I'm sure we can talk about later. One of the advantages is the efficiency, as Dan has mentioned, but another big advantage, and this is one point where I think governments, banks, and digital payment providers, they all agree, is the elimination of large banknotes, because large banknotes seem to be used mainly for illegal purposes. And so everyone seems to agree on that, on like eliminating large, banknotes, because it is true that having electronic means of payment lead to lower crime rates because there is no tangible money to steal. They lead to less money laundering, less illegal financial activity. Well, unless you're using cryptocurrencies, because there is always a digital trail.
Yeah.
It's much more efficient because handling, storing, depositing paper money, it actually costs money. So if you can do all that in a much more efficient way, you can actually be saving money. It simplifies a lot international transactions, and for consumers, if you travel internationally, it's very convenient to have electronic payments, obviously. And then I will talk about this probably during the people part of the discussion. It also enables having a personalized experience because through the analysis of all the digital trail that people are living, you can actually build individual models of your behaviors and of your patterns of consumption, and build financial advisors that might help you make wiser, financial decisions. And that could also help build more trust in people, in using these kinds of systems.
Nuria, let's come to that in the people section, because I just want to stick, and I want to bring in Frank D'Souza, if I might, because Frank, I'd like to just pick up on that point that, that Nuria's just making, which is, you are looking at obviously a moment of really, intense disruption. In your cognizant days, heaven knows you know a lot about disruption. Now that you've moved into Banco Santander, I'm interested to know what you think gets displaced, what gets disrupted. Nuria mentioned cash. There are certain kinds of businesses too that obviously are going to get disrupted or displaced. And there's a massive question, of course, for banks, as Dan suggested in his opening comment. So can you just think through for us a little bit what an acceleration to the digitization of payments means?
Yeah, well, it's great to be with you all. Here's what I would say. First of all, I largely agree with everything that's been said by Dan and Nuria. I think to answer your question, James, it's interesting to think about in a human sense, the relationship that individuals and businesses have with their money, with their financial transactions. And it really falls broadly into two categories. One categorization, or one model that that's helpful, is to think about, sort of fast money versus slow money. Fast money is the relationship that you have with your daily expenses, your bill payments, the things that happen on a day-to-day transactional basis. Slow money is the things that you're worried about for the longer term: your pension, your retirement, your life insurance, your investments, and so on and so forth. And those things are very, very different in terms of the emotions that people have relating to those things. When you're thinking about fast money, you're really thinking most about convenience, And as we digitize, fast money is going to be all about, can I make payments at the moment of truth, whenever it is that I'm transacting? As I'm buying something, can I also take a buy now, pay later loan? Those kinds of things. It's all likely going to be about convenience. But on the slow money side, I think this is where people's emotions are more about trust in the financial system, trust in the financial institution that I'm transacting with. And therefore, it's about the brand, the credibility, the balance sheet, really importantly, because is there somebody who's going to stand behind this? Because slow money are usually long-term things. And so I think as we think about the digitization of the economy and the financial system in particular, the way we digitize around fast money and the way we digitize around slow money, I think is going to be very different. And much of what's been said so far, I think, has related more towards the payments and the transactions, which tend to be more in the fast money category.
And Frank, let's understand something. Let me put this in the language that you would expect of a British journalist, which is the language of the pub, right? So what happened to the British pub in the last sort of 25 years is that people used to just come in and have a drink, but then increasingly they said, but why don't you stay and have something to eat, right? So in your comparison between fast and slow money, my reading of banks is that for many years, it's been the case that the fast money, those transactions create the relationship with the bank. And the slow money, those longer term services are the ones that are essential to the success of it as a financial institution. What happens when people aren't coming in for the fast money? What happens to the slow money services?
Well, look, I think that the imperative for banks is to be able to do both, but to do them in different ways. So I think that fast money transactions, James, are going to be dispersed throughout the workflows and the customer journeys that we all go through on a daily basis. So, you're going to see fast money when we transact, when we buy as an e-commerce. You're going to see fast money transactions when we go to a healthcare provider. We're going to, those transactions are going to get embedded across the economy in our day-to-day lives. And so the imperative for banks is to make sure that we're there. We're there whenever those transactions are happening, because that in turn creates and sustains the relationship that then evolves into these slow money kinds of services that banks are particularly well suited for.
And then, Frank, what about the question about the impact of digitization on certain sectors of the economy? Because I'm going to put this question to Dan in a moment too. It seems to me as though the history of digitization has been that the unintended consequences are more and bigger than we expected. And when you look at this in terms of payments, we started off by talking about efficiency. We started off talking about inclusion. There's a lot about this that clearly, as Nuria suggested, is to like. But the things that we can't always foresee are what are the disruptions and what are the unintended consequences? What should we begin to think about or worry about on that front?
I would say, James, first of all, I'll go back to what Dan said, which is that we are living at this incredible moment of technology where cost to serve has never been lower. The access to technology, the availability of the cloud, the availability of infrastructure around the world. I mean, we've never been in a situation in the history of humankind as we are today. And on top of that, we haven't even begun to touch the topic of the vast amounts of data that we're throwing off and what that allows us to do from all sorts of perspectives, not least of which is to being incredibly more targeted with what products and services we offer to whom, and getting much better about making credit decisions, making financial inclusion decisions than we've ever been in the past, and being able to do that at price points and at cost points that we've never done before. So we have this opportunity. I think we're at the cusp, as Dan said, of an era where we actually can make financial inclusion and financial health far more of a reality than we've ever been able to do in the past, because our cost to serve going forward with this combination of low cost computing plus data is going to enable us to serve the long tail in ways that we never could before.
Right.
Well, I want to point some disadvantages.
I'm going to come to you in one moment. I'm going to come to one moment. I'm going to do two things. I'm going to come to Dan, then I'm going to come to Nuria. But first, I'm going to make amends for my mistake at the start, because I'm giving technology a bad name. It turns out that it wasn't the technology that was at fault. It was me, because this wasn't supposed to come up on screen. It was on the screen of the website. So I'm just going to make sure that everyone knows the three questions that they can answer, because otherwise the drum roll at the end of our hour, when we reveal the polling, will fall a little flat. So the first question that is on the website, and you need to refresh the page to answer it, is: will a cashless economy be more or less inclusive? Right? So will it be more inclusive or less inclusive? You can refresh the page. There's a second question, which is, and it goes to your point you were just talking about there, Frank, who will provide more financing to the economy in the medium term, the tech sector or the banking sector, i.e. banks or Silicon Valley? And then the third, and you hinted at this, Nuria, who do you trust more with your personal data, banks or Silicon Valley? So those are the three questions. More inclusive, less inclusive? Is it going to be banks or Silicon Valley that provide more financing? And the personal data question: who do you trust more, banks or Silicon Valley? Please do answer. And if the tech in this section had feelings, I apologise to it for failing to step in on its behalf. But Dan, I want to just come to you, because I want to pick up on Frank's point, then I'll come to you, Nuria, in a second. Dan, paint for us, if you will, listening to what Frank and Nuria have said, what the next 3 to 5 years looks like in terms of the revolution in the financial services sector. Are we moving to a world of dominant tech platforms, massive fragmentation, displacement of banks? Does it change more gradually than we think? What's your outlook?
Yeah. Well, first of all, I would say, as I think about your second two questions, I think they're kind of loaded questions, and you did that on purpose. But because I think that every company is becoming a tech company right now. I mean, like it used to be the Valley and, traditional, but like banks are becoming tech companies. Healthcare companies are becoming tech companies. Higher education is being forced to become a tech type of company. And, depending on the sector in technology, there are big differences between social media companies and other tech players in the Valley as well. And so what I think you'll begin to see over the next 5 years is, first of all, Frank said this, but I would just emphasize the point. We are at the very beginning of this tech revolution. I mean, it's just starting right now. Let's, say in the next 5 to 10 years, you'll have the beginnings of true quantum computing that will take processing power to levels we've never seen before. I mean, it's real. I mean, it's the equivalent of 1 quadrillion, transistors, on a chip. I mean, just radically different processing power, speeds in terms of wireless networks at you'll be able to download a movie in 1.5 seconds. And computing power moves out to the edge. So battery power lasts longer. You'll have much more Internet of Things that'll happen. And then you'll have very sophisticated algorithms informed by machine learning and artificial intelligence, as Nuria has pointed out. And so there are a couple of things that happen naturally as a result of that. One, actually costs come down quite dramatically and continue to come down. In fact, really, when you're talking about software, adding an incremental customer costs you almost zero. And then you've got costs of the actual services, but they come down quite dramatically at scale. Second, you have a tremendous amount of data and information. And so with that data and information, if used properly, and we have to, like to your point that you were getting at before, there are real issues around data privacy, around security of that data that I think are fundamental. Because remember, we were talking about trust. And so that has to be that is a role for those who are providing at least financial services at a minimum, and regulators to work hand in hand on how do we assure security and protection of customer data and privacy. But that data and information, James, can be used in unbelievable ways. And I actually start to maybe, I don't know if I would disagree with Frank, or I just maybe add to what he's saying is you're going to see a blurring between what he calls fast money and slow money, because that data and information informs how we think about lending and how we think about cash flows for those who are underserved. For the most part, cash flows, it's not that expenses exceed revenues, although that happens at the, those who are, struggling every day, but it's the unevenness of those cash flows and having data and information to smooth out those cash flows, and also I would point out that different segments of the market think very differently about, their trust in different segments. Like if you look at the more millennial segment, Gen Z, those growing up, they were born with screens, and we need to understand that. And their trust of different institutions come in very different ways. And, their distinction between private and public is very different. And so I think we're going to continue to see an explosion of data. We're going to see a radical increase in technologies. Things will move much quicker. our ability to serve customers in innovative, low-cost ways that I think can enhance security, enhance comprehension, like budgeting capabilities, et cetera, and enhance our ability to provide innovative, cost-effective services around both commerce and financial services will increase dramatically. At the same time, James, it'll put a burden on all of us to work hand in hand together, because no one company can do it alone. Regulate one regulator versus another, it's hard for them to do it alone. This needs to be a team sport, and platforms can enable that, but it's complicated and difficult, and we all need to lean in together.
So Dan, can I ask two things that flow from that? I'm really interested by your idea that Frank's notion of fast and slow money, the line blurs. That would suggest to me that we're going to see a world where what we currently think of as tech platforms are going to begin to look more like banks. I'm going to see banks begin to look like, or try to look more like, tech platforms. The two questions that flow from that are, one, whether or not that's accelerated by a flurry of mergers and acquisitions, whether or not we see in financial services the equivalent of AOL Time Warner, possibly not as disastrous as that as a merger, but you see what I mean? Something on the tech side and something on the established banking side. And the second question is whether or not we see a fundamental rewiring in regulation, because, as you say, the lines between the two look increasingly blurred.
Well, I mean, I think we're seeing some of that today. I mean, I'm seeing retailers go into financial services. I mean, look at some of the largest retailers or marketplaces, because a ton of commerce is now going through marketplaces as opposed to individual retailers who are coming into those marketplaces, and those marketplaces have their own payments capabilities. Large retailers have their own payments. Tech players are beginning to move into payments. And so I see a lot of players moving into payments. I think some of them are better equipped than others to go do that, because, again, you need to have all the regulatory frameworks and foundations and compliance and risk management, fraud management, FinCEN. It's not easy. It is a heavily regulated industry for the right reasons. We depend on the financial system. And so I think you are going to see a host of people try to do this, each of them for different reasons, supporting different parts of their business model. But I do think we need to think in general as an industry about what could be, and really not an extrapolation of what was. Right. And I think that's I don't think this is sort of we're just going to get kind of more efficient. We're going to slowly, I think like most of these things, there is some form of disruption. Central banks, I mean, what is it? 1 out of 10 central banks are thinking about CBDCs, central bank digital currencies. Well, for a lot of good reason, they're thinking about it, and so I think, as you think about the role of central banks, their ability to issue maybe directly through digital wallets to consumers, what is the intermediaries that they do that? How do they do that? I think there's just going to be a ton of change. And I think we all need to keep go into the conversation with an open mind about how we can serve consumers and small businesses better than we do today. Right. And there's clearly room for improvement.
Dan, thanks. Nuria, I cut you off earlier on, and I know you were jumping in on something that Frank says. I suspect you'll have comments on what Dan says. And I'm really interested to hear, too, what you think about the system.
Thank you. I mean, I just wanted to mention a few things. So the first one, actually, but I don't know whether I should reveal the answer, is that the same question that you are asking about whom would you trust with your data, we actually asked that question in 2014 in a study that we call Money Walks, which was trying to understand the value that people attribute to their personal mobile data. And we asked people whom would they trust with their data, and the options were myself, banks, telco companies, because it was mobile data, and then there was insurance companies and the government. And I don't know whether I should reveal the answers or wait to see if these have changed. Sorry?
You've got to tell us now. This is 2000.
Okay. So the number one by a lot with a score of 0.997 was myself.
Right,
so everyone trusted themselves the most with their data. The number two was actually banks with 0.54 score between 0 and 1. Then telco companies very close with 0.51. Then the government. This was a study that we did in Italy. So I think that depends on which country you're talking about. And it was 0.49. And then insurance companies were the lowest with 0.46. So I'm very curious to see what people would answer now. The other thing that I wanted to comment is we've talked a lot about trust, because trust is absolutely fundamental. And it's actually, I would say, not a coincidence that the digital payments kind of like revolution started around 2008, rooted both by the financial crisis and the adoption of smartphones, and sort of like the birth, of smartphones. And, with the financial crisis, there was no liquidity, people had difficulties to borrow money, and there was a big distrust in the banking system. And at the same time, people were buying these devices, and there were all these services, that were being offered. So building trust and being able to sustain the trust is absolutely necessary. And how do you achieve that? So to achieve trust, at least three conditions need to be met, which is the first condition is competence. You actually have to do well whatever they're trusting you to do, right? If it is, keeping your money or exchanging money or sending money, you have to do well. And that connects with the issue of possible technological vulnerabilities. And Dan has very rightly talked about how important security is. It is absolutely critical, because as opposed with physical money, where you don't scale, with digital transactions, if you can hack a system, you can actually access, millions of accounts, or you can actually, get access to the tremendous amounts of money that will be very difficult, in a physical world. So competence is very important. The second one is reliability, which is competence sustained over time. So it's not good enough just to do it well once and then not to do it again. And the third one is honesty and transparency. And this goes to the dimension that has been mentioned, and is an absolutely critical dimension of privacy. We can't ignore that tremendous amounts of personal data are being captured and will be captured the more we transition towards a cashless society. And that data will be analyzed and will be monetized, but there has to be transparency as to how it's analyzed, how it's monetized, and of course there has to be the security that is not going to be wrongly analyzed or monetized.
Can I just ask you, Anuria, can I just ask you about that? Because I wonder, when we talk about data and privacy, right, is there a risk that the whole technology sector gets painted in the same color? And the reality is Facebook and Google and these firms have built a business model which is around selling that data. FinTech has not built business models around, or largely not built business models around selling that data. So what happens is people worry about, quote unquote, the tech sector or Silicon Valley and their data, but they're actually just reflecting their lived experience of, companies like Facebook, etc. That's not fair. It's like comparing a high street bank with a high street retailer. They're doing different things. They just both happen to be on the high street. So how do we interpret differently what's happening in the technology sector?
Yeah, well, first of all, they don't sell the data. What they sell is maybe modeling and patterns and profiling that they can do from the data. So that's a very important sort of like nuance. The other thing that falls within the lack of transparency is that there is really no transparency as to what kind of models they have of each of us and how they leverage those models to subliminally impact our behavior or our decision making, right? So the point that I was trying to make with this is that governance is going to be, and it is already, a critical element in all of this. And if we don't have the right governance, we won't be able to build the trust, because there will be cases where that trust will be broken. And as we all know, it's very difficult to rebuild trust, once it's broken. Yeah. And then very quickly, in terms of the limitations, because we talked about data, privacy, vulnerabilities, hacking, security, there is other vulnerabilities, which maybe we don't think so much about, but it's important to think about them, which is glitches, outages, or even innocent mistakes like forgetting to charge your phone could actually turn you into a penniless, useless person that can actually do anything, right? So we also become very vulnerable to having a functioning electrical system, or to having a functioning network, and where cash, is more robust in that sense, because it's not going to run out of batteries. And then the other two factors that I think we should, sorry, okay.
I'm just aware of the time, so I just want to come back to Frank, so I'm going to come back to you on this people question at the end, if I might. So forgive me for doing that. Frank, if I might, I just wanted you to pick up on the points that both Dan and Nuria were making, because firstly, I think the competent security and privacy point that Nuria made as the sort of building blocks of trust, right, are obviously really testing for a big financial institution as it moves digital. I'm really interested to hear what you think about what Dan says about us going into things with an open mind about what could be, right? And I wanted to sort of hear from you really on two fronts, whether or not you take an established bank, and it's not just Santander, I'm talking about established financial services businesses, and just imagine what they could be. So it's the same question I put to Dan, what the next 3 to 5 years looks like. And Frank, in that context, bluntly, whether or not there's any way that our politicians and regulators can keep up with that change.
Well, there's a lot to unpack there in that set of questions. Look, I think on the let me go back to the issue of data and privacy and start there. This may be stating the obvious, but I think it's worth stating that given the Nuria's the survey that you referred to, people trust themselves first and foremost, and so. I think a core principle going forward on data, and we have to get there, and I realize lots of work to do, but people have to own their own data. There's no question about that, right? That has to be the core guiding principle, and staggeringly, that isn't the case today in many cases. And I think that if you anchor around that principle of individuals owning their own data and others being able to use that data only with consent, then in some form, then I think you can start to address some of the issues, James, that you talked about. For example, different business models amongst the big tech players. And I would argue further that today there's an implication that because I use your service, therefore you own my data in some of these big tech players. That's not acceptable, right? It's I think particularly if I'm not paying for your service. Particularly if I'm not paying for your service. If I'm not paying for your service, the saying goes, right, then I'm your product, and you can't. It's so the anchor should be on that is individuals in control of their own data with and only the ability to use with consent. Look, if you look back at the history of regulation has largely followed innovation and has not preceded innovation. So regulation has largely been in reaction to innovation as opposed to in anticipation of innovation. Mm-hmm. And I'm not sure I see that changing, but that's not necessarily a bad thing. I think as long as we have prudent dialogue between regulators and industry and innovators, and those things are continuing to happen on a regular and an ongoing basis because the pace of change is increasing, I think we can keep the economy, we can keep our financial system going forward safe and secure.
Dan, do you want to come back on that?
Which part?
Well, it's just the confidence in the regulatory system.
I think it's difficult for regulators. I think it's difficult for the industry to keep pace with all of the changes. I don't think regulators are at a particular disadvantage. I honestly believe things are moving so quickly that we do need to think about where are they moving towards and start to anticipate that a little bit more than wait for them to move and then regulate. And I think the EU has taken quite a proactive stance around some of these, like around data management, around privacy, and I think they're leading the world in that, and I think it's been very healthy. So I do think that regulators and industry need to view themselves as partners in this. I think that's a really important point. We aren't, we aren't at odds with each other. We're all trying to, I think, do the same thing. It is to drive financial health. It's to create the ability for all of our citizens to feel part of the system, to be sure they're not excluded from what is going to happen going forward. And then the real question is, like, how do we do that together? What are the sandboxes where we can experiment? How do we think about that? But this is I live in this world of fintech. That's all I do. And it is, one thing after another every single day. And so it's not surprising that anybody's feeling, that it's difficult to keep up with everything.
Well, in that spirit, we've had a number of questions. I just want to fire a few of them at you. I'm going to do a few in a different way. So Anne told, and this is a question for you, Frank, which is, with all these players moving into payments, as well as the increase in digitization of payments, do you see a risk of the gamification of money, that there's going to be more fast money, as you put it, and that's going to risk higher indebtedness of financially less literate consumers?
I would say that I go back to something Dan said, right, which is that as we focus on financial inclusion, the focus has to be not just on inclusion, but on financial health. I think that's a critically important point. Dan made it somewhat in passing, but I think we should spend a little bit of time on it, because to me, financial health is really the goal, not necessarily. Financial inclusion, I don't want to be glib about this, but financial inclusion can happen given the changes in technology that we've all talked about. Their cost to serve is coming down, and therefore I think just the natural dynamics of that will create more inclusion. Right. Getting inclusion is just the baseline. Health is really a much harder baseline to get to, and that is really where we have to focus. And I think if we do that, there is a risk that if you have more inclusion, as you said, I'm not sure it's the gamification of money, but there is a risk that you have people that are overextended and so on and so forth. And so we do have to be more prudent. But I think if you take a holistic approach to financial health, and this is where, the other point that I would endorse that Dan said is the partnership between regulators and industry is so important. I think we can get ahead of it. I'm not sure that I agree with Dan on the issue of regulators getting ahead of the pace of change. I mean, I wish that would happen. I think it would be fantastic if that were to happen. But the pace of change right now is so fast that I think for the foreseeable future, we'll be in a world where regulators are looking back on innovation that's happened and saying, how do we regulate around something new versus being in a position where we're systemically anticipating innovation and regulating prospectively.
Well, but I want to support Dan because I agree with him, actually. I think it's what I call a smart regulation or intelligent regulation. I mean, it's knowing where you're going to go and designing the framework that would accelerate going where you want to go according to certain principles that are somewhat stable over time. So it's not so much the detail of this technology versus this other technology. It's defining a sufficiently broad and long-term vision that would actually create a little bit the playing field where things can happen. And for me, one of the key elements is having a human-centered perspective and really defining what are the main principles that would ensure that we have a human-centric perspective. So the other pillar that we haven't talked about, but I think is absolutely fundamental here, is education. one of the biggest limiting factors is that regulators, and more broadly speaking, decision makers and policymakers, do not have a lot of education in technology, unfortunately. And I think this is absolutely necessary to be changed. And I think this is one of the key reasons why having collaborations between regulators and policymakers and industry is very important, because a lot of the knowledge is in industry right now. You can't obviously regulate about things you don't understand. So this is fundamental. And the same goes for people. And this is my last point. The same goes for people. I think with technology-enabled financial transactions, we have a little bit of maybe the perfect storm from a person perspective of two areas where there is a huge lack of education in the population, which is financial aspects and technology. And if we don't invest in educating in those two aspects, one of the key human-centric elements that we already know from doing electronic transactions, financial transactions, is that people have a very difficult time in budgeting. There is no physicality to it. There is no pain of seeing the money leaving your wallet. And it is very, very difficult for people to have a sense of how much money they're spending, what they're spending in it. So having a human-centric perspective, would define, for example, what are the guiding principles to make sure that, the tools are there to help people have a better understanding of the big picture, of their own finances and the financial decisions that they are making. Sorry.
No, actually, I was only interrupted because I wanted to put a question to you. Well, firstly, I wanted to do one thing, which was to let everyone know what the results of the polls were. Oh, yeah. So happily, everyone did weigh in, notwithstanding the delayed start. So here's what everyone said on the call. Will a cashless economy be more or less inclusive? 50.9% said more, 49.1% said less. Who will provide more financing to the economy in the medium term? 78% said banks, 22% said Silicon Valley. And the third question, who do you trust more with your personal data? 92% said banks, and 8% said Silicon Valley. I'm going to come back to Dan on that last one, because I think he might suggest that we're leading the witness on that. But I'm going to come back to him in 1 second. But Nuria, I just want to put a question to you. Paula Gomez asked this one question, which it seems really important, touches on a point you made right at the beginning about the impact on people of a cashless society. If cash disappears, what would happen with the elderly who do not have enough knowledge to use the new technologies, or with people who don't have the resources to acquire a phone from where to pay, for example? So economics and age, and picks up on your education point.
Yeah, totally. So we've talked about how mobile money was actually early adopted in developing economies as a tool for financial inclusion using feature phones, but we cannot ignore the fact that if we move to a truly cashless economy that fully relies on people having access to and having the knowledge of using technology to be able to make financial transactions, we do have to have an inclusive approach. And again, we go back to the human-centric, elements of it. We do have to understand that obviously not everyone has access to a smartphone, that not everyone has the ability to use it, that not everyone has the dexterity or the vision to be able, to use it, or people that might not want to also. I mean, there's also maybe the issue of individual freedoms, right, and choices. So this is something that needs to be analyzed and that needs to be taken into account without a doubt. Something that I learned preparing for this session.
I must stop you just because we've got 2 minutes left. I want to have 1 minute for Dan and 1 minute for Frank too.
Sorry.
Dan, thank you, Nuria. Dan, 1 minute for a massive subject. How does the tech sector change the perception of trust around data?
Well, I think, again, you need to sub-segment it because I think a lot of the tech sector has a very good reputation. PayPal's reputation among millennials and those who use it is extraordinarily high. And I'd put our trust up with any financial institution. And we would have one survey after another that would support that. I do think this idea of who owns what data and consent is very important. And I don't think that tech or platform companies should abdicate the responsibility for what they do with data, what data is allowed and on their platforms. Like, we have a very strong moderation policy on PayPal. We take down any site that tries to use PayPal or Venmo for hatred, racial intolerance, violence. We just don't support it. And I think that is our responsibility to go and do that. So I think each company needs to look at this. It's a very complicated thing for each individual company, and we each try and lump things together, which I think is unwise. And we also tend to think we understand what's going on in these other tech companies, and they're big, unwieldy, very large companies that have a lot of things to think about. And I never try to put myself in their shoes, but respect what they're trying to go do.
Dan, thank you. And Frank, one also less than a minute for you in this final question, which was nearly 80% of people see the bulk of financing coming from banks in the medium term. Do you think we're underestimating the pace of change?
I think you always underestimate the pace of change in the short term. I think you always underestimate the pace of change in the short term. So I think that's right. But I also think that the results of our survey show that the incumbents, the banks, have a number of great assets in trust, in particular, and so I wouldn't discount the incumbents, the banks, from the trust that they have, the relationships that we've had with clients over decades, and our ability to, the question here will be, can banks become tech companies faster, or can tech companies become banks faster? And I think that's the thing that will play out, and there'll be a happy medium, I think, over the next decade.
I also think there'll be partnerships as well.
Yeah, I was thinking about the same. I was thinking there will be marriages, probably.
Yeah, we end then in an exciting world of things moving faster and people coming together, something I think that, given the year that we've had, we'll be excited about on both fronts. Next week, we're going to be looking at the climate challenge, climate change in the age of COVID, a sustainable, resilient recovery. We're going to be joined by Peter Backer, who many people will know from the World Business Council for Sustainable Development, José Linares from Santander, and Teresa Ribera, who is the Spanish Vice President and Minister for the Ecological Transition in Spain. But for today, a huge thank you to everyone who's on the call. One of the things that's annoying about digital is that you can't hear the applause, but trust me, you'll be hearing it. Frank D'Souza, Dan Schulman, and Nuria Oliver, a verbal round of applause to you, and a good day to everyone.
Thank you.
Thank you very much.
Bye. Have a good day.
Thanks.